The stock market is closed and we see a lot of red right across the board, a very poor day, but one company in particular, that is Nvidia under the spotlight, is down around 10%, which is quite a large amount for a company in the Mag 7. And when we zoom out and look over the last week, we can also see we haven't been on a good streak with the S&P overall, and in fact over the last week as well, Nvidia has been suffering, down 14%. If we extend this to over the last month, we can see again the market not looking that strong, and in particular again Nvidia is down. And we just want to highlight the fact, even when we do look at the last 3 months, whilst we do get a bit of a mixed result right across the board, the one common denominator here is that Nvidia has been on a very poor run. In fact, just over the last 3 months, as we can see, the company has been crushed around 18%. Now, you could argue when we look at last month in particular that February is typically the second worst performing month in the year, with September being the first, but there are also other factors that we do need to consider. So today we want to very quickly understand, why is this company crashing, and should we consider this as an undervalued buy in our portfolio? And a quick spoiler alert, we do believe this is a great company to consider. Now, over the last year, they are still up 34%. Key takeaway though, today hasn't been the best day as they are down 9%. And I'm sure you're aware, over the last 10 years, this company has massively outperformed the S&P, up more than 20,000%. But now we are starting to see the company in the mid to low end of the 52-week range. And Wall Street themselves do consider this company a strong buy, with Seeking Alpha also calling this company one to buy in your portfolio. But one news that maybe has slipped by today is that Nvidia's unofficial exports to China do face some scrutiny. As we can see, there was the arrest of some silicon smugglers in Singapore, and we can see now that 3 people have been charged of deliberately misrepresenting the final destination of US manufactured servers. Now, why this is very key, because remember, Singapore here does account for 18% of their total revenue, and that is based on their customer billing allocation. However, less than 2% of revenue in terms of the product shipped to the country. So you could see here potentially that sales to Singapore are leading to other countries, and that is one that we don't know yet the extent of how much Nvidia will be punished, but they could be in some serious trouble. Again, nothing has been confirmed. The other thing we need to consider right now is that part of this drop to Nvidia is that we could be seeing a stock market rotation, where investors are now moving out of stocks that have performed very strongly, especially in the tech sector, and moving to others that have been lagging quite significantly. As we can see here, technology as a whole is up around 36% in 2024, but as of 2025 so far, we can see they are the worst performing sector. As we can see today, pretty much the majority of sectors have been hit, with some areas like healthcare and telecom services in the green, although only fairly marginally. The other thing that we want to point out here is that there's the first quarter that essentially we will see negative GDP growth, and that isn't good, especially when we are anticipating growth to earnings of several large companies, which will in turn help with their share price. But if overall growth is starting to slow down, we need to understand the wider impact this will have on the overall economy. And one thing that is really harming the market right now is that Donald Trump has confirmed that he will be imposing the 25% tariffs, and for Mexico and Canada, these will now start on Tuesday, and do remember the additional 10% to China. We just recorded an episode a few hours ago when we did look at the Fear and Greed Index, where we had moved out of extreme fear into the fear bracket. Now we've moved back right into extreme fear, and investors are now getting a lot more bearish than they were just last week, where we did see around 4 consecutive days of the overall market dropping. The other thing to note here is that Donald Trump today did announce a $100 billion investment in the US from Taiwan Semiconductors, and he calls this company the most powerful company in the world. Now, whether or not you believe these words have any meaning, if they'll ultimately have any wider impact on Nvidia, something to consider, but we can see here it wasn't too long ago that he did call out and accuse Taiwan of stealing US chip manufacturing businesses and touting tariffs on semiconductor imports, so that is something that maybe can be seen as good news for the wider economy and TSMC in particular, but again, Nvidia and the impact of that may not be known at this point in time. Now, what we really want to drill home about Nvidia is that right now this company is on a high. Just their latest quarter, we saw them grow 78%. They believe artificial intelligence demand is still very strong, and they have the numbers to back that up. They also had very strong guidance for the next quarter, which analysts did love to see. And something we have seen on a very consistent basis with this company is that they did report a double beat, revenue outperforming forecasted, and the earnings per share also coming above. They also blew out analyst expectations where they said they see 43 billion in the next quarter, that is Q1 of financial year 26, and the analysts were expecting under 42 billion. We also noticed their bottom line for the quarter was up 22 billion, when the same quarter last year it was nearly half of that at 12.29. And just remember, they are continuing to increase on their data center revenue. 36 billion out of the 39 they reported in this latest quarter did come from data centers, and if we just look at the same quarter last year where it came in at 18.4, right now we have seen them nearly double that figure, with their total revenue looking equally as impressive. So there is a lot of growth that we are still seeing in the numbers. In fact, if we look at their earnings over the next 4 quarters, they anticipate double-digit growth, fairly strong as well, whilst also outperforming over the last 4 quarters, giving them a 100% track record. And look at this, based on their earnings per share estimate, this company now trades at a forward valuation of 27.8. And whilst we do believe the majority of the market is trading at significant valuations well above their last 5 years, we actually believe that Nvidia is one of those where it is warranted. As we can see, the sector as a whole at 23, so you are paying a 22% premium, but look at what they were valued over the last 5 years on average at 48. Right now, you are getting a 42% discount, and that is something that we can see no matter which valuation metric you look at today. Nvidia trades at a premium to the overall market, but they are trading much lower than their last 5 years. And if we take a look at this valuation metric with the blue tunnel indicating the expected fair price, one thing to note is we want to see this increase over the longer term, something we see, but what this indicates right now in terms of their trading price, it is significantly lower than even the bottom end of the expected fair value, meaning lots of disparity. This looks to be severely undervalued, but we'll get to that when we do look at it through our own valuation model. In terms of why they deserve a premium, first off, against the market, they've got an A- on the growth. Year-on-year revenue up 114%, the sector at 5, above even their own 5-year average of 63. Over the next 12 months, still fairly large at 60%, well above the sector at 6.4, well above their 5-year at 39.5, and they also anticipate to grow the earnings per share 35% over the next 3 to 5 years, when the sector comparative sits lower at 15 and their own 5-year sits lower at 27.54. We also want to highlight profitability looks very strong at an A+. Gross margin 75%, well above the sector at 50, well above their own 5-year average at 65. Bottom line, 56%, above the sector median at 4%, above their own 5-year at 33. So they're not just increasing their revenue at a faster rate over the longer term, but they've also been improving on their margins against their 5-year average, lots of efficiencies, whilst also generating a significant amount of cash from operations, 64 billion over the last year, well above the sector at 103 million, well above their own 5-year at 15.3 billion. We can also show you against others in the sector that are comparable like Broadcom, TSMC, Texas Instruments and a few others. They have had a fairly strong return. Over the last year, they are up 32%, very similar to Broadcom and we can see TSM, but when we expand to over the last 5 years, no one comes close, 1,602%, and over the last 10 years, the disparity between first and second place is still very significant. Nvidia massively outperforming not just the S&P, but also some others in the sector. Now, do bear in mind that past performance isn't reflective of the future, but it is good to see that over the longer term, historically, they have performed very well. In terms of the institutions, 66% ownership. Now bear in mind, this is for the last 12 months, so all of 2024. But even though we saw 68 billion worth of sales, we saw 391 million worth of buys, and we saw in the most recent quarter, institutions buy nearly 3 times as much. So they have been very bullish. Institutions clearly love this company. They have been buying a lot more than they have been selling. The other thing that we want to highlight here is just the massive difference it's currently trading at against their own 5-year. On a forward P of 25 to 26, over the last 5 years, on average, it's sat at 43. And the metrics we want to highlight, given we have said this is a high quality company, we want to back it up even more. Now, free cash flow payout, we will just point out we tend to ignore earnings data as it is susceptible to manipulation by management through accounting. For free cash flow payout, because they do pay a dividend, although fairly trivial, it sits at 1%. If they wanted to, they could continue to increase it at the triple digit rate. But the free cash flow per share has been increasing massively, at least over the shorter term, and anticipated to continue 388 over the next 12 months. Massive jump from even the previous year. Sales growth last 2 years, as we can highlight, have been strong triple digit growth. And remember, with this growth, we only expect it to get higher. If you just remember the other companies in the Mag 7 when they reported their earnings, we had Amazon who planned to spend 100 billion to capture what they call a once in a lifetime opportunity in AI. We had Mark Zuckerberg's Meta who said they were looking to spend around 60 billion in the full financial year. Microsoft who reiterated their 80 billion spending, and we finally had Alphabet who the investors weren't happy about because they were looking to spend a significant amount more at 75 billion. So we do anticipate their sales growth to only go higher as they do capture more and more of the spending by others in the Mag 7, especially in relation to artificial intelligence. And just over the last year, we can see their top line more than double, going from 61 billion to 130. In fact, we saw the same in the previous year. Then when we take a look at the ROIC, we want to see 10% or in fact 12% or more for this specific industry to give us faith that management are able to effectively allocate their capital. One of the best we have come across on this channel, sitting now at 90%. And then we want to talk about efficiencies, which we briefly touched upon earlier. This is a company, not only their margins above the minimum, but it has been increasing over the longer term, something we typically want to see, or in fact we do see for companies that are very high quality. And there's a free cash flow machine, consistently very, very high, now sitting at 47%. And the final metric here, the net debt to EBITDA, we want below 1.5. Remember, this correlates to balance sheet strength, and the numbers you see below or lack of are the number of years it would take the company to pay off all of their debt net of cash on hand. This highlights for Nvidia it won't even take them 1 day and hasn't over the last 10 years, so they have a very, very strong balance sheet. Now, before we just jump into our own valuation model, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, so we have just delivered one earlier on where we look at severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll also be able to gain access to undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can also grab a spreadsheet of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move into our valuation model, which gets to $162. Now this is derived from the DCF model, where we have the free cash flow year on year. We have the most updated free cash flow from their latest earnings, and you can see over the last 5 years, free cash flow has grown 153% year on year. Over the last 10 years, 104%. Now moving forwards, we've gone 20%, which you could already argue is fairly conservative, but as always, these numbers that we have here for the low, medium and high are subjective. You can always grab a copy of this model by clicking on the pinned comment below, run your own numbers, whether it's for Nvidia or any others. But based on 20% and the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, intrinsically 162, which translates to 44% upside. Now we'll show you for full transparency, for those that believe that is way too high, at 15%, it isn't far off the current value. So what this means, if you're buying this company right now, already baked into the numbers is a 15% growth rate to their free cash flows over the longer term. And for those that are a lot more optimistic, at 25%, $227, that is 101% upside, pretty much a double from now. So if they can grow their free cash flows at 25% over the longer term, you are seeing a 2x. Now, typically on this channel, we do like to take through the median rate of 20%. We're not done just yet because we do like to add a margin of safety. We start off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data, which you could argue Nvidia already has, meaning a buy up to $146. Then we keep going till it's near the current trading price. Right now, we see an MOS of 30%. Wall Street themselves still very bullish. We saw that strong buy rating. They see this at $180 over the next year, translating to 59% upside. As always though, do give us your thoughts. Is this one you agree is a buy? Maybe you're looking to sell, or is just purely a hold? Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon as well, where we do cover our weekly buys and sells, and we have been buying over the last few weeks given the volatility. But as always, have a great day, and we'll see you all on the next one.